All right, so I think we are live now. So Justin, welcome back to the channel. Today we're talking about living on the edge, specifically because you and I both did that and probably did it longer than we should have, but learned a lot along the way. And so wherever you go, there you are. Here we are.
Exactly. Yeah, that was your computer was rebooting, so I was like, okay, let me watch your latest video, and I watched your Living on the Edge video, and I was like, man, very, very similar scenario as me. I've been investing maybe a couple years longer than you, but the same happened for me. If you look at a chart, it basically was like deals and properties and money and everything. And then for me, it was about 6 years in, and the seventh going into the seventh, that was when I had just been on the edge for too long. Ended up doing deals that were outside of my normal wheelhouse, and quite frankly, the last 3 years, I've been spending unwinding a good chunk of what I had been doing up in those 7 years of the build phase.
Yeah, so you were pressing the envelope a little bit. What did you learn while you were out there? Because I feel
Mhm.
like if you got three sides to a coin, right? If you're on the edge, the beauty is you can look at both sides of the coin. You can see the good, you can see the bad, and there's good and bad from pushing the envelope. I truly believe that. What were some of your takeaways?
My biggest takeaway is the separation from the what I call Gen Pop, so the general population of people that there's the wannabes and then there's the doers, right? So very quickly, I was going to local meetups, and at the time, I was on Bigger Pockets, learning and everything, and asking questions. Very quickly, you can separate away from the rest of the pack by doing stuff. And when I very first started, I was, on the fundamentals, the very basic stuff, cash flow, analyzing all my returns, and I had money that I had built up. As I started speeding up, buying more and expanding, that's where I started getting more and more into what we're talking about, living on the edge, where I was borrowing more money, I was doing new stuff, i.e., partnerships. I was going into new states. I had different types of funding. So I moved into, like, I had a retirement account that I had used to start buying real estate. So it got more and more and more complex as I got going on. And that's what ultimately I think got me was doing the same thing over and over again was pretty easy to add. As I started doing more new stuff, that's really when it started to become heavy and friction and slowing me down.
So getting off of that, right? You're taking some management in house, you simplified your portfolio, and I feel like we took some pretty similar actions. Would you do it differently?
I don't think I would do it differently in terms of the start, the launch, if you will. The scaling, knowing what I know now, the scaling, I would have changed that around instead of, massive expansion all at one time. Is um, you know, hindsight's always easy to analyze. If I literally would have done five of my first properties, literally would be more cash flow than I have on the 30 that I have today, and more equity, and much less stress. So, I would have done more house hacking at the beginning, because it's a uh, lower cost to get in, and I would have bought more locally in Seattle area versus predominantly out of state.
I think what I would have changed, I learned so much that I couldn't have learned, doing the whole scale
Mhm.
thing and doing the partnerships and everything that I've put out on YouTube.
Right.
But if I had just stopped at the 30 rentals and moved into one of my units, and
Yep.
for those that are tracking, right, 30 rentals was three properties for me. It was three purchases. If I just lived in one of them for free, life would have been so much lower stress.
Yep.
I tried to bring that point out in my video that I posted last night. It's like just because you can and you can learn all this stuff, it doesn't mean it's going to actually benefit you the way you want it to.
Mhm. Exactly. Yeah, there's properties I bought in hindsight. I'm like, man, I wish I never would have bought them. But they were there. They were low dollar amount. And sometimes those can actually be the most the most challenging ones, right? Because the more that you do these deals, and I would say more of the at least on my side was the seller finance creative offer ones, especially when you're working with distressed sellers. Those can be a little bit more um, challenging over time to deal with. Because in those you're doing a deal today, but you're still talking to those people through the life of that loan product. So those are things that I've learned as I've gone over time.
Yeah, absolutely. If you can get, and that's why I'm transitioning into like Class A stuff. I'm trying to get HUD loans and like the 35-year fixed. If you can just simplify your universe and not have a ton of
Yeah.
CapEx and not have all the projects, and I think Matt the Lumberjack talked about this. It's like if you keep doing projects, you're just going to stay poor.
Mhm. Exactly. I was watching Zuber the other day. He's on his boat. He's doing his daily financial news, right? And I'm like, how's he able to do all this stuff with his portfolio? And I've been thinking about that the last 24 hours. And it's because he's been doing it for a long time, but he has very structured, he does the same thing over and over, my assumption, over and over again, to where I think he's in Bakersfield, if I remember right, in California. So he really knows that one area. It's all structured in that one area. It keeps it more simplified versus I have multiple properties in multiple states and multiple property managers, entities, and all that. So I have all this extra complexity. So we're talking about at the beginning, how do you get off the edge? Is simplifying that. So the last couple of years, I've exited states, I've exited properties, I've exited, refinanced, and got out of the creative stuff into longer term debt. So I'm trying to simplify things to make life much easier, and less stressful.
10 of 10 recommend.
Yeah. And the other thing, your video yesterday, you were saying like every month you were getting 10 figure, or not 10 figure, that'd be amazing if it was 10 figure, but 5 figure CapEx items, right? And what ends up happening when you're running on the edge is that no one deal would take you down, but what ends up happening is Cody had multiple per month. For me, sometimes I'd have multiple in the same month. So it's just like it's kind of Murphy's Law will end up ultimately coming out, where it's like I had a flood over here, I had vandalism over here, I have vacancies here. All these things start adding up to where the cash flow is just whips on, right? And the more you can simplify things, the more you can standardize, then the actual income comes in and is more stable. And that's how, like, back to Zuber, that's how he's able
Yeah.
to keep it so his life structured.
Yeah, and I felt rich at that point in time because I had equity, I had cash flow, not as much as I do today because it was property managed. I was gonna say professionally managed, but that wasn't the case. And
Yeah.
and I had cash. Like if you have
Yep.
all three of those things, it feels better than if you're missing one. Like it's a three-legged table. If you lose one, you fall over.
Right.
And so I had all those three things. And so for the first time in my life, I started feeling pretty good. And then my portfolio showed me how that can be taken away like that. So I
Right.
got whacked and it felt like every single week. And it was the dumbest stuff. Like I had to repipe multiple units. I had to redo a sewer line.
Hmm.
Repiping units is expensive, especially when you have to dig through the concrete.
Yeah.
It's a lot. And I did that on a bunch of units. I had a mold issue where I had to take it basically down to the concrete wall because it's concrete block for that building and then stucco. And I
Yep.
had to put up moisture barrier, frame it out. Of course, I'm paying for this. I'm not qualified to do that. And
Right.
to do mold remediation on multiple apartments because there was an issue in how it was built. So it was just ridiculous. Like, it's week after week,
Hmm.
14,000, 8,000, 10,000, sixteen
Right.
thousand, and all of a sudden your cash goes away.
Exactly. Yeah. I know exactly where you're at. You have the cash, and then it goes as soon as it builds up, then it goes up. Then like for me, like then it's like, okay, now I'm pulling off a line of credit. Okay, then okay, now all the bleeding stop. Okay, now you got to pay the line of credit back, and then now the line of credit's paid back. Now you start building up cash. But these cycles can really decrease your liquidity, your dry powder, and then then now you're borrowing. And it's like when something can't go wrong, it's when it kind of goes wrong, right? And then the other thing is like for you, for example, when you're dealing with mold, it's not I'm gonna wait until next month. You can't wait. These have to be done, right? Because you have tenants there, you got to worry about health issues, and you know, on bigger scale stuff, you want to make sure you're not going to get sued. So when you actually find out about them, it isn't planning it out. It's just you have to do it, and then that gets more expensive.
That clicked for me when I bought the Robinhood, and for the couple months I lived on site before, I realized that it was crazy to put myself 2 hours, round trip outside of my normal business area. That clicked for me. There were
Yep.
tasks that had to be done. And the prior owner was like, well, what are you going to do about it? It's like, I don't know. It's like, well, you have to do this, 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 and this. It's like, yeah, but I don't know how to do it. It's like, that doesn't matter. It has to
Yep.
get done. And I've never really been in that position before because I was 22, I think, when
Mhm.
we bought that. So, like, I just wasn't exposed to that world for task oriented maintenance and upgrades. So,
The
sometimes
beauty,
you just got to figure it out. And that's how it was
exactly.
when I redid. So I had to redo some plumbing. There was a point where I didn't have like the 10 or 12 grand to pay a plumber. And so I figured out how to do what they did through ChatGPT, through YouTube, and through asking help from a buddy who's done it before. And
Yep.
it works. And they showed me how to backfill it and
Yep.
all that fun stuff. But gotta do what you gotta do to make sure everything's working. Can't have
Yeah.
poo coming up someone's shower.
Yeah, I mean that's the beauty and the curse, right? So, yeah, over time I've done the same thing. Like I'll look at something how to do, and I'm a big YouTube University guy, so I'll watch like a ton of videos on it and then figure out how to do it, right? It can be as simple as like we had one time, we had a clay pipe at one of my houses where the trees had got in there, so it ended up flooding the basement. We had to get a vacuum truck to clear it all out, and so then I'm like, well, how do we get the lines clean? So then we hired got a hydro jet. And then I'm like, well, how do I make sure it doesn't happen again? So, you know, so then it's very simple. There's like this tree killer type stuff.
Yeah.
I should say tree killer, root killer. So like twice a year, I buy the root killer, I pour it in there. Usually when a tenant moves out, if there's tenants that are in there, I just come in, pour it down, let it do its thing for a couple hours. And then the other thing we did is we part of the reason why it was so expensive is that there was no clean out on the exterior of the house. So they'd have to crawl into the basement and then do all the work, which made it more time consuming. So when it happened, I spent a little extra money, had them do a clean out outside so that if there is an issue in the future, they literally can just go to the outside. They don't have to bug any of the tenants. They just go to the outside of the house through the clean out, take care of the work at that to make it much simpler at that point.
Exactly. That's something that I've been doing too at all my properties. So my 39 unit, every building has clean out. At my 12 unit, the buildings all have clean out. The um 15 plex, all the townhomes, of course, have clean outs because they're new. But having that type of stuff and the systems put in place makes life so much easier. Because I remember when I was doing plumbing work on those buildings and they didn't have clean outs, you had to either take the toilet off or you had to go
Yeah,
in under the sink and yeah, it was just a lot. Takes time.
yeah. Or you're going through, you have to get on the roof and then do a sewer scope down through the roof. Yeah, there's all these different things that come up. But I think the key there is that we, by living on the edge, we had to just figure it out. Uh, there's no waiting, right? So we have to either find a solution on our own, or we have to work with the providers and figure out what is the best solution. So, more so on the stuff that's out of state, I can't physically go there and do all the stuff. So it's like, how do I work with
Why not?
the
Millennial Mike is.
oh, is he living over there right now?
No, I think he just flies over there to do the maintenance stuff,
Oh,
like the
wow.
CapEx.
Oh, yeah.
I made
Well,
the
that would,
argument, and it was either in his channel or in Dion's channel, that that was a poor use of time,
yeah.
but you can do it.
If, I mean, I don't know how many properties he's got over there, but I mean, if he has a lot of projects at one time, maybe it makes sense to go over there at a minimum. What I always struggle with is like, are they actually getting enough quotes? Are they billing me the right amount? Because there's usually a quote, and that's kind of it. And then I want, labor and material. I'm like, was it really the 10 hours that you quoted, or did you get it done in 5 hours and you still billed me for 10? So I'm always trying to figure out what is a better way. Obviously, if you're there, you can audit it, but
Right,
you really want to do that every month in Gary, Indiana, or for me, Milwaukee, or
right. Flavio said that we're rich enough where we should just be in the Bahamas all the time and not stress about anything.
yeah. Well, I just dropped a note in there. My thing is less is more. So getting off the edge was less is more has been my motto. And that's really been, less states, less property managers, less partnerships, less complexity, because like in reality, like if I, because I'm about a third of the portfolio has been sold off, related to the partnerships in Michigan and selling out of that stuff. So that's definitely simplified things. I think I'm probably going to still simplify, sell some more off, and just get back to a core base. Then, what I like to call will be like my fortress, if you will, where that's stabilize better quality assets and then start building back again off of that. But only once I get to a core, consistent, stabilized base. I'm still not there yet. Getting back into self-management, that'll help things there. But I do want to get it to where there's the properties that I have, that they're good properties for the long term, not just properties that are going to make money on paper. They're properties that will make money in reality, right? Because that's some of the other stuff I learned is, yeah, they look great on paper, but when you actually own them, when you start factoring in unit turns and tenant issues, they're not making money. Yeah. Now, if they go up in value, okay, great. Now, yes, I did make some equity. But on the Midwest, I try not to factor in appreciation. So they need to be standalone cash flowing as they are. And the appreciation is, this is gravy on top.
And I'm curious, as you continue to do the transition, what property size will become too small for you?
Hmm.
Like that's something that I'm looking at right now. I'm refinancing some of my back and forth. A little while ago, we were going back and forth. Let me reorganize my thoughts on my triplex. Remember the prepayment penalty I was telling you about is
Yeah.
8.65 and 5% prepay. So I am refinancing that. I'm lowering the rate to 5.8. I'm going to eat the prepay. Going to increase my cash flow though, 400 to 500 bucks a month,
Yep.
which is
Nice.
incredible. So I'm going to optimize that for cash flow. But back to the point I was trying to make before my thoughts all got jumbled for some weird reason is that property is probably too small to keep.
Mhm.
Do you see yourself looking at the portfolio like that of, well, this is too small to justify holding? Like I'm doing this Ellensburg deal that I've shared on YouTube and been telling you about. Now that's trying, I want to push the property average size to that.
Right.
Do you think you're going to do that to further simplify rather than having, I mean, however many units you have, let's say you have 50 units. Do you want to have 50 units amongst 10 buildings or 50 units amongst two or amongst one or amongst 20? Like what would be ideal?
Yeah. I mean, I like the more that I talk to you, the more I like multifamily because you have the opportunity, the NOI factor, where for every dollar you increase of income, it's exponentially more based on the cap rate. So, do I want to get into that? Yes. Right now, I'm not focusing on scaling up. I'm actually focusing on scaling down. Now, I'm still going to own single family properties that in that portfolio. But once I get it stabilized, I think I'm going to get into more of these commercial properties. I just saw that it looks like your cat was behind you there. Um,
Oh, she is probably high.
yeah,
Catnip is the thing,
yeah.
being very odd.
I think in the short run, I'm still going to have, majority of what I have today is the smallest obviously is 1 unit. The biggest is an eightplex. So I'm going to stay in that space for now until I stabilize it. Then I think over time, what will end up happening is trading the smaller ones for bigger ones. So, if I trade a duplex, maybe it goes to a sixplex, eightplex, whatever. More so in the out of state stuff, because like around in Seattle area, with the way the appreciation game goes, and assuming what I buy in this area has land behind it to build, I'll keep those as land banking in the Seattle area. So I still want Seattle, when I say Seattle, 1 hour Seattle, single family with buildable lots, behind it. So I'll always have single family locally, but I foresee myself scaling up on the Midwest stuff.
Cool. Looks like we got a comment. I understand that my point of view is not agreed upon by everybody. Why would it be too small if the cash flow is optimized? I'm going to try and explain this as simply as I can. If you have, let's say you can only have 5 assets. This is a made up scenario, but it's just to illustrate a point. If you're going to have 5 assets, asset A, B, C, and D, gross income 20,000 a month, net cash flow 5,000 a month after everything, right? So these assets are cash flowing 5,000 each. You have the liability and the benefit associated with all these assets. Asset E, gross income 3 grand a month, net cash flow after everything and the mortgage 500. The You saw the liability of the ownership of that asset. People are going to say, well, the argument that there's more tenants in the bigger one, but do I want to have liability associated with owning anything if it's going to produce 1/10 of my average deal over here? Like I got 4 producing 5 grand and I got 1 producing 500. Now it's not that simple in real life, right? They're not all equal at 5 grand and 20, but I've got one property that the gross rent is more than a couple of years of rent. Like the monthly rent on this asset over here is like 3 years of rent for my triplex.
Mhm.
That's just like a gross comparison, but I would have to get 100% collection on my triplex with no expenses for 3 years to equal 1 month of the asset over here. So even though it would cash flow, and at that point it'd be like $600 a month net cash flow, $700 a month, and I have no money in it, it doesn't make sense to hold.
Mhm.
So that's why.
I think obviously it's a personal question that everyone can relate to, where as you start scaling up, when you scale up, you're going to have different problems. When it's like 0 to 5 properties, 5 to 20, 25 plus, right? So, and as you were describing your scenario there, I was thinking about it in the terms of, from a financial perspective, when you're looking at costs, you look at fixed costs and variable costs. Now, when we're in, because at my peak, I had 45 properties in 4 states. Now, there's what are called fixed time items and variable time items, right? So, for example, when you're doing your bookkeeping for 45 properties, each one of them has their own like books, right? Versus if you had one large property, right? So, if you think about it from a fixed time and a variable time, there's a lot more total time consumed with smaller properties than one large property. Another fix would be I have property managers in every state, right? If you had just one property manager managing one large building, you only need to talk to that one property manager each month, right? So for me, I'm talking to multiple property managers every month versus one property manager every month. So there is scale for time basis. That's what I think Cody's number one question is. There's a time thing. Cody talked about um, risk, right? Do you want that much potential liability is another thing, right? So I do like the factor of scaling up from a time perspective. So that's why I think more so in the out of state stuff is how do I scale these properties, sell off the smaller ones, get bigger ones. So then it's less is more, but in terms of a time factor as well.
I'd like to point out that this doesn't, like what we're talking about right now, does not matter just to hit financial freedom. Like there's no property too small in my eyes to hit just financial freedom.
Right.
There was a conversation I had with the real estate guy, and of course, this is like a gross example, but they said, I was telling him a little bit about what I've got going on. And they said, "Oh, congrats, you're just getting started in real estate." After I told them about the portfolio that I built, I was like, "Really?" Like, so there are levels like financial freedom and then building the business. They built a massive business. I don't think that's what I ever want to do. But I think if I wanted to get to where they're at, I would have to really consolidate and fix some of the smaller properties. I don't think I could get there without
Mm,
like a property minimum size, which is unfortunate.
right. And those are the guys that do the art of successful syndications, right? The real estate guy? Are we talking the same person?
No, I'm talking about someone else just in my local market. They literally
Oh,
just told me that like a week ago.
got it.
Like I mentioned about the townhome assemblage and the Ellensburg deal and a different property here in town that I thought was like a big deal. And they're like, "Oh, congrats, you're just starting out." Like,
Yeah.
that's a
Everything
blow.
is, I know. It's like a humble brag and elevation there. But it's one of those like as people, because I'm sure there's people that watch this, whether it's now or in future land, that either own zero or one properties. It's not a problem that you have today. You're going to get to that if you continue to do this over time, right? Uh, we like to talk about Dion a lot, right? I think he's in 19 units, something like that, and like 8 or 9 properties. Now, if he would have started when he was Cody's age, that number would be much bigger just because that'd be 30 years of investing versus 10 years of investing, right? And so, even if like Cody and I literally we're not trying to grow our portfolio from here on out, we're there's problems that are going to come up with that, right? Because like just if Cody did nothing and he paid for literally because you're young enough, you could pay all these 25-year AMs off, right? Now you're sitting on, eight, 9 figures by the time you pay it off, 8 or 9 figures
Hmm.
probably of
Yeah.
of equity. Okay, so now what do you do with that equity? You know, we're always trying to figure out what is the best use of that equity. Should we put it into um, alternative assets, right? Should we diverse and put it some into stocks? We were talking about gold before we came onto this call, or Bitcoin if that's your thing. So um, the point of the story is that everyone has different phases of where they're investing at, and we have different problems that we're trying to solve. And I would say, if we're looking at the baseball analogy, I'm really only in like the probably third or fourth inning of investing in terms of baseball's terms. I'm just starting to get to better understand what I want to do. And I'm kind of into that second, I went to the first growth phase, kind of stabilizing. Once I get everything stabilized, which I think will be by the end of the year, then I can focus on next level of growth where I'm more purposeful, more strategic about the purchases versus just buying that next closest easiest thing to buy.
Yeah, love it.
Let's see, we got a couple more comments in here. Oh, it looks like Flavio is saying that that's why he's going to start selling off his single families at some point in time. Um, I'm not sure how many, I'm assuming he's in the probably in the 10 plus units, I would imagine, over in
Yeah, and
East
again, the
West.
unit count doesn't matter. Like you could consolidate from 7 houses to a sevenplex,
Hmm.
going from Class C homes to Class A townhomes, right?
Right.
I mean, that's feasible for people to do. And it just depends on the goals, kind of like Alex's question or statement. We have different goals and different perspectives in our 20s than we do in our 40s. Yeah, probably. But we probably want the same thing. I mean, my guess is that most of us want enough in the simplest fashion possible. That's what I'm shooting for now. I need to
Exactly.
simplify. If I could just have my original 30 units paid off today, I would take that. But there's no tax efficient way to get there. It would be so expensive to do that. So I can't do it. So now I have to scale into nicer stuff and then just pay that off and hold it.
Right. It's one of those things like I was thinking about this the other day because um, before I took these, development projects, that those are what my two biggest pain points, which, as of June, both of those are done, right? So, it's July 1st, 2026. I'm finally my first month in over 3 years where I'm not starting the month negative 12,000 a month just on these two properties were negative 12,000. So now the ability for me to recapitalize and then, stabilize a portfolio and then go to the next phase, I'm like super pumped and motivated to now be in a spot where in hindsight, I was already, if I go back to 2022, I'm effectively back to where I was in 2022. Now that I got finished those projects, you know, what's interesting is like, I'm happy to be back where I was basically in 2022. By trying to grow too fast, getting too close to the edge, ultimately that ended up setting me back. I learned a lot in the last couple of years, and it's forced me to get better at other stuff, right? So, like, on my side specifically, it forced me to like, well, if I need income, I need to generate other incomes. That's hence the origination of the Cambra group and the real estate agent stuff to help solidify stuff in the short run, right? I'm sure Cody had to figure out how to generate money. Like you did the hotel conversions. I think that was like, and you had the education. You had to figure out, you know, you already had the assets. You got to figure out how to plug these holes when they come up. So you have to generate active income from somewhere. For me, it was the agent side. For you, I think you did the hotel conversions. Does that sound right?
Well, I mean, the hotel conversion gave me 100 grand, but that was also years into my deal,
Yeah.
right? So I didn't pay myself cash flow for a while. So what I ended up doing is when I did my cash out refi, I put 6 figures tax free in the bank and coasted on that. So what I had done for a longest time, and now like the accounts basically they go up slowly, but I'm finally
Mhm.
paying myself out of the portfolio more than I use. And back then it used to just big cash injection and then it would go down. And big
Yep.
cash injection and then it would go down. And it was terrible.
Right. Yeah. And that's the and that's been like that for me. When you are consistently scaling, there's always something that's burning cash, right? So when you get the new property, you're doing some sort of value add, taking that money and putting it in there until you like pause, stabilize. You know, let's just say for simple math, 10,000 comes in, 10,000 goes out. You made no cash flow, right? Because you're always kind of buying the next thing and trying to optimize it, right? It's not until like for me, what I've seen is by slowing down, not buying, restructuring the stuff I got, selling off, that's when I'm actually starting to realize the cash flow. What I was ultimately doing before, yeah, I was just taking the money that was generating the property to buy more property, which then created more expenses, right? So until I got it stabilized to where the properties I have are cash flowing, that that was the biggest difference for me. It's like, okay, now I can actually see the cash flow is coming to fruition versus always buying and then trying to make more money on the next deal. I don't know if you face the
Yeah.
same.
Well, I mean, that's how I feel now. Now that I've kind of settled out and put it on chill mode,
Yeah.
like I'm paying myself more than I've ever paid myself before. I didn't get to do that before. When I was in scale mode, basically cash flow would come out of the 39 unit and it'd go to me. And then it would go from me to this other property. So I'd get a distribution in property A and then a contribution in property B and
Yep.
stayed broke. Like
Exactly.
it sucked. And now that just about 100% of my portfolio is cash flow positive. I have the one union property that's not, which sucks,
Right.
but it is what it is. Do what you got to do. That, um, other than that, everything here is at least positive.
Yeah.
So
That's
finally,
a key thing you were just talking about there, because I have you might be different, but I have multiple different entities. And what you were talking about, I had historically done that, right? So if you have entity one, two, and three, entity one, it makes money. Entity two and three are have negative month. So you take money from entity one, plug it into entity two and entity three to keep them all surviving. The goal is to make them all positive, self-sustaining on their own. And that's where I'm getting everything back to in 2026. So once you're back to that point, then you're at a foundation of strength. For me, I wasn't on a foundation of strength because I had one that was really negative, right? So then I was having these other ones that kind of support it, right? So now that that's done, now I can have each of these different entities generate their own cash flow, grow on their own moving forward.
yeah. Well, looks like we're out of comments. So I think we'll wrap for today. I got to call an owner. I have to get an extension. I swapped banks and you know how fun that is. And they're assigning the appraisal, but they're like, are we closing this week? Nope.
Oh
So,
yeah,
but it's okay. They're gonna get their money.
yeah. Couple days, couple weeks won't matter. It's if they're not getting paid for longer than that, then it can be an issue.
Yeah. So, all right. I think we'll wrap for today. And
Sounds
Justin, it's
good.
good